Hi, I want to talk to you today about mortgage interest rates. A lot of people come asking about how they're set. What does the Fed have to do with it? And what goes into how interest rates are set, when they go up, when they go down, all that sort of thing. So, I just want to talk to you today about that, give you some insight into the process, and also to give you some tips so you can get the best possible program which involves your specific situation and your specific finances. All right, so let's get started. It used to be that when you wanted to buy a house and you wanted to get a mortgage, you would go to your local bank and speak with a loan officer, and they would qualify you and go through the process, and you'd get a loan. And then that lender, that mortgage company, or that bank would then keep the loan, and then you'd go back there on a monthly basis to pay it. I remember my parents had a little booklet that they took their checkbook, they paid the bank, and they noted it in the booklet so they knew where they stood, what was the balance, what they paid, what's the interest, and that sort of thing. Somewhere along the line, some genius decided that mortgages weren't just simply a way to buy a house, but now they were going to become an investment vehicle for financial institutions and for others as well. This brought into play what's called mortgage backed securities, MBS, wherein mortgages were created by the lender, sold to a secondary institution who bundled them and then made them available for people to buy and sell as investment instruments. So ultimately, the interest rate that gets charged is set by the lender involved. But the factors that create that interest rate ultimately and whether it goes up or down is dependent largely upon demand of these mortgage backed securities on the secondary market. If demand is high, that may push interest rates up. If demand is lower, that may push interest rates down. But one of the biggest aspects here is that demand of mortgage backed securities is what helps a lender determine what rate they're going to offer on any given day. Now, based on that demand, interest rates generally they get reset on a daily basis, but often, depending on the volatility in the market, they can change on an hourly or several times a day basis as well. But the main factor in all of this is that interest rates are set based on the profit that's going to be gained more so than any other factor, and that's determined by the demand for mortgage-backed securities. So that's the biggest aspect of how rates get set. Ultimately, the lender sets it based on how much they think they're going to make over the period of time they have the loan. Once it's been settled, then it's going to get sold on the open market. And they're going to recover the money they lent plus a profit on top of that. So that's when the lenders make their money on the actual loan. Now, there are still some lenders who loan their own money and service their own loans, portfolio products as they're known. But that is not the vast majority of loans on the market these days. One of the main indicators of what's happening with mortgage interest rates is the rates on treasury bonds issued by the federal government. If treasury bond yield goes up, often you'll see that the mortgage rates go up as well. So they tend to parallel each other. So that's another indicator to watch. Now, one of the big questions and big confusions is the effect the Federal Reserve has on mortgage interest rates. So while the Fed does have an influence on mortgage interest rates, they don't dictate nor do they direct what rates are going to be on a daily basis. Mortgage interest rates are dictated and affected by the global economic market. So if the Fed decides to raise or lower the short-term interest rate, that can give the market an indication as to what inflation is going to do or other economic indicators. And so mortgage interest rates may track with that a little bit, but there's no direct correlation between what the Fed does with the short-term interest rates and what mortgage rates will do. It's interesting to note that the Fed does purchase mortgage-backed securities. So if they see an economic indicator that warrants this in their minds, they will buy or sell those securities on the open market, which can then affect the demand for them, and that would then affect the interest rates that may be offered. So the Federal Reserve does have an influence on mortgage interest rates, but it does not have a direct correlation, nor does it cause directly whether they go up or whether they go down. So it's an important thing to understand. Another major effect on what interest rate is set for you personally is your specific financial condition, your specific financial situation. Leading up to the economic difficulties we encountered in 2007, 2008, 2009, many people who went to get a mortgage were given one simply because it seemed like they could make a mirror fog. If there was life in that body, give them a mortgage. That created a situation wherein there were lots of economic losses across the board, collapse of the housing market, and that sort of thing. So there have been guidelines and regulations put into place so that people do now have to qualify based on their income, based on their credit worthiness, and other factors as well. So it's no longer a point of can you fog a mirror to get a mortgage? Now you have to prove your ability to repay it. Some of the things that will affect what rate you're going to get directly is the type of housing, meaning that condos may have a higher interest rate than a single family home. Your credit score, how much money you have in the bank, what is your history on paying things off in a timely manner, which of course affects your credit score. What's the loan to value? How much are you putting down? How much do you have in reserves? There are a lot of factors that go into this, and that can play a big factor in what interest rate you ultimately get. You should understand that no lender, generally speaking, is going to lock in a rate for you on a mortgage until you actually have a home under contract. They don't just say, hey, here's your rate, and then wait till you buy a house. It's the other way around. You have to get the house under contract, and then you go to them and see what the rate is going to be for you, because it does factor in the type of house, where it is, and other factors that are related to that. Anyway, each of these factors that I've just talked about and others will alter or potentially affect whatever rate you're going to get in the final analysis. But generally speaking, lenders will revise their pricing for mortgage interest rates on a daily basis. If the market's volatile, you can sometimes see various changes throughout the day, but minimally, they will come out with new pricing on a daily basis. And whether it changes or not is tied very closely, as we mentioned, to the mortgage-backed security market and similar economic indicators. Once you've determined what sort of program you're going to get and all of that, then you can lock that rate in. And the length of time that you lock the rate in also is going to affect your rate. So you can lock it in for 15 days, you can lock it in for 30 days, 60 days, 90 days, and each of those rate lock periods, as they're called, can result in a different rate or maybe a different cost for getting that rate. So keep that in mind as well. Now, there is a factor here in this market of DMV, DC, Maryland, and Virginia, since house prices on average are higher than much of the United States. We also have different categories of loan. So you have conforming interest rates for conforming loans, you have jumbo rates, and then you have high balance conforming. So each of these classifications of loan based on loan amount and down payment will vary as well. So that's another thing to keep in mind. What's interesting is that the Fed can raise or lower interest rates based on economic indicators. And since those are short-term decisions, more so than longer terms, you might find that mortgage interest rates will go in the opposite direction, meaning that if the Fed drops the short-term rate, that can signal certain indicators of the economy, and that could end up resulting in higher mortgage interest rates and vice versa. In summary, there are various indicators that come into play which control, direct, and dictate what mortgage interest rates are going to be at any given period of time. The wrong question to give a lender is, what's your interest rate today? Because there is no single answer. I will tell you this, that if you take the interest rate and program that one lender gives you and using your own credit scores, you can go to another lender and compare, and sometimes you do a little bit better. So it doesn't hurt to try to shop around. Once you've got a rate and a program quoted to you based on the home that you are under contract for, you can go to another lender and make a comparison, and sometimes you can come out a little bit better. Keep in mind that the lenders are generally speaking using the same investor money, so there's not going to be a whole lot of difference from bank to bank to bank when it comes to that. But if you can get 1/4% or 1/8%, that can change your payment a bit, and it doesn't hurt to try. You have a certain period of time once your contract's in place to do a little shopping, and you should take advantage of that and use it to your advantage. If a particular lender hasn't been busy lately, he might agree to a change in the rate, drop it a little bit. Sometimes he has to get approval, but it's not uncommon for the lender to be able to negotiate a little bit to get your business. Ultimately, realize that mortgage interest rates are tied more to the global economy than the local economy or what the Fed dictates. You do have some recourse. You can shop around. You can improve your own financial condition and such to improve what loan product you can in fact get. And there are lots out there. There are different options to choose from, more so now than there were even as far as 10 years ago. So take advantage of that. But realize that it's not up to the Fed, it's not up to the government, although both those areas do have influence on it. It's not the bottom line. And you do have some control, although maybe not as much as you'd like, on determining what your interest rate is when you make your next purchase. So good luck with that. And if I can be of any help, you let me know.